Breaking news coming out live right now at this moment as Federal Reserve Chair Jerome Powell is sharing with us the latest on interest rates and inflation and what is coming out of this meeting. And this is going to be impacting everybody. If you collect Social Security, those COLA increases are going to be determined by what's happening right now. If you've got credit card debt, if you're thinking about buying a house, everybody is going to be impacted on the decisions that are being made in this meeting right now. Now, I'm going to share with you live exactly what's taking place, but take a look at the headlines that are rolling out right now. The Feds keep interest rates unchanged for the first time since January of 2022, as they're saying there will not be an interest rate hike at this moment, but that does not mean it's the end, and it does not mean that there has been a massive flip in the economy. It just means they're taking a pause. And I've shared with you here on the channel before that increasing or decreasing interest rates, that's one thing, but the speed at which it happens is another, because the dramatic speed that takes place, and we've done it at a record pace, is what can break or make the economy. And so they're saying that it's time to pause, but we might not necessarily be done. Don't get your hopes up. And also, they're going to be talking about inflation here. And what we're seeing is that, yes, inflation has slowed year over year. But again, don't get your hopes up, because last year it was pretty nutty, as you'll recall, with gas prices and everything taking place. And core inflation in and of itself is still on the rise. We are still not in a good situation, and we're going to be seeing what unfolds, because we still might need some help getting through this. Now, take a look at this before we get to the video footage. This is the full statement that was released. Recent indicators suggest that economic activity has continued to expand at a modest pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. So even though things are starting to get stabilized, they're saying it's still likely that we're going to be taking a hit here. The extent of these effects remains uncertain, though. The committee remains highly attentive to inflation risks, and the committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run, and that's typically the number we always hear that they want to increase at, is 2%. In support of these goals, the committee decided to maintain the target range of federal fund rates at 5 to 5.25%. So they're going to be holding to that target, which means no more increases, but we're going to stay flat here for a little bit, but more might be on the way. And if I had to guess, my guess would be more rate hikes will be coming. Now, we will see. Anybody that says that rate cuts are on the way, I'm just going to be honest with you. I think that's a very optimistic opinion. I've heard some people that are involved in real estate say that, and I just honestly don't see it happening. I feel like as quickly as we shot up these rates, they're going to hold tight for a little bit. They might go up even a little bit more. I could not see them coming down, especially in our current economic environment. I might be wrong, but I think they're going to hold steady. And like I said, this is going to be impacting all areas across the board of our economy. A lot is weighing on the decisions that we're hearing coming out of this meeting. So let's go ahead and dive right in, though, so you can hear it live. I'm just going to jump right in. You can hear a clip. And if you appreciate the updates, hit the like button, hit the subscribe button. And as more comes out on this, I'll let you guys know how things will be impacted. Let's take a look at Jerome Powell and what he has to say.
Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile and food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25% and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated, interest rate sensitive sectors like housing, while they've felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting, and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
So there you have it. That was just a little snippet of what is going on actually live at this moment right now. And again, as more comes out on this and how it's going to be impacting Social Security, our economy, everything taking place, I will keep you up to speed here on the channel. Now, in addition to that, speaking of inflation, as they try to slow it down, if they pull it down too fast, we could go into a deflationary environment and we might actually need to re-stimulate the economy. And a lot of people are saying that that is exactly the recipe that will result in more stimulus checks. Speaking of which, if you missed out on stimulus checks because you did not file your taxes, we received a warning from the IRS that you have a limited amount of time to make sure that you claim those funds. And I share with you the forms you need, step by step, everything you need to do if you are afraid that you might be missing out on money that was set aside for you that is about to expire. Now, to get the latest on that, be sure to check out this video right here next as I cover it in detail. And I'll keep you up to speed on everything as it rolls out. But you guys, that is the latest, and I'll be sure to share more. Take care. God bless. This is Steve.